Assalamualaikum warahmatullahi wabarakatuh. My name is Puspita Dewi. I am from class accounting B. Fixed asset. What is a fixed asset? A fixed asset is a long-term tangible piece of property or equipment that a firm owns and uses in its operation to generate income. Fixed assets are not expenses to be consumed or converted into cash within a year. Fixed assets most commonly appear on the balance sheet as property, plant and equipment, or PP&E. They are also referred to as capital assets. How a fixed asset works. A company's balance sheet statement consists of its assets, liabilities, and shareholder equity. Assets are divided into current assets and non-current assets, the reference for which lies in their useful lives. Current assets are typically liquid assets which will be converted into cash in less than a year. Non-current assets refer to assets and property owned by business which are not easily converted to cash. The different categories of non-current assets include fixed assets, intangible assets, long-term investment, and different charges. A fixed asset is bought for production or supply of goods or service, for rental to third parties, or for use in the organizing. The term fixed translates to the fact that this asset will not be used up or sold within the accounting year. A fixed asset typically has a physical form and is referred in the balance sheet as property, plant and equipment, or PP&E. When a company acquires or disposes of fixed assets, this is recorded on the cash flow statement under the cash flow from investing activities. The forecast of fixed assets represents a cash outlet to the company, while a sale is a cash inflow. If the flow of the asset falls below its net book value, the asset is subject to impairment write-down. This means that its record value on the balance sheet is adjusted downward to reflect its overvalue compared to the market value. When a fixed asset has reached the end of its useful life, it is usually disposed of by selling it for a sale value, which is the estimate value of the asset if it was broken down and sold in part. In some cases, the asset may become obsolete and may no longer have a market for it, and will therefore be disposed of without receiving any payment in return. Either way, the fixed asset is written off the balance sheet as it is no longer in use by the company. Special considerations. Fixed assets lose value as they age because they provide long-term income. These assets are expensed differently than other incomes. Tangible assets are subject to periodic depreciating, as intangible assets are subject to amortization. A certain amount of an asset cost is expensed annually. The asset's value decreases along with its depreciating amount of the company's balance sheet. The corporation can then match the asset cost with its long-term value. How a business depreciates an asset can cause its book value. The asset value they appear on the balance sheet to differ from the current market value at which the asset could sell, then cannot be depreciation unless it contains natural resources, in which case depreciation will be recorded. Fixed asset vs current asset. Both current asset and fixed asset appear on the balance sheet, with current asset meant to be used or converted to cash in the short term, less than 1 year, and fixed asset meant to be utilized for the longer term, or greater than 1 year. Current assets include cash, the cash equivalent, accounts receivable, inventory, and private expense. Fixed assets are depreciated while current assets are not. Fixed asset vs non-current asset. Fixed assets are non-current assets. Other non-current assets include long-term investment and intangibles. Intangible assets are fixed assets meant to be used over the long term, but they last physical existence. Examples of intangible assets include goodwill, copyright, trademark, and intellectual property. Meanwhile, long-term investment can include bond investment that will not be sold or matured within a year. Benefit of fixed asset. Information about a corporation asset have card is accurate financial reporting, business valuation, and thorough financial analysis. Investor and creditor use this report to determine a company's financial health and to decide whether to buy shares in or lend money to the business. Because a company may use a range of asset methods for recording, depreciating, and disposing of its assets, analysts need to study the note on the corporation financial statement to find out how the numbers were determined. Fixed assets are particularly important to capital-intensive industries, such as manufacturing, that require large investment in PP&E. When a business is reporting persistently Negative net cash flows for the forecast of fixed assets in could be a strong indicator that the firm is in growth or investment method. Examples of fixed assets. Fixed assets can include buildings, computer equipment, software, furniture, land, machinery, and vehicles. For example, if a company sells products, the delivery charge and owns the use or fixed asset. If a business creates a company's parking lot, the parking lot is a fixed asset. Note that a fixed asset does not necessarily have to be fixed in all sense of the word. Some of these types of assets can be moved from the location to another, such as furniture and computer equipment.